In the back of your book, hot off the press, there is several financial statements guides. Those guides were presented by NADA over hundreds and hundreds of dealers through 20 group meetings that they have accumulated over the years. And in there, you can see a certain bracket, for example, sales compensation. It ranges anywhere from 10 to 13%. Manager's compensation, it ranges anywhere from 5 to 7%. And what we're going to go over right now this morning, or towards later this morning, what's going to happen is we're going to go over a few of those expenses, and we're going to go and pinpoint where some of you are way off the chart. For example, if you're paying your salespeople on the statement 25, 27%, can you make that up in volume? You are fast forwarding all the way to bankruptcy. Now, I know some of the managers over here, well, hold on a second, we pay our salespeople 30%. We'll explain what that means. We'll explain what that means. What you want as a manager or as a sales manager or as an F&I director, you want your dealer to make a lot of money. You want that particular dealer that you work for to be extremely healthy. Because if he's not, you got nothing anyway. You have nothing anyway. And my managers, my sales guys, they all were very, very excited when we posted up big profits. Because I rewarded them accordingly. If the statement made a lot of money, I shared a lot of bonuses with them. If the statement didn't make a lot of money, guess what? There was some adjustments to be made. So, that being said, I'm going to go ahead and give the mic back to Greg and Bill. And again, gentlemen, it's really a true privilege having you guys here. Thank you very much. Thank you.
This is the Acura. It's the first page. And what I want to try to make this as easy for you to understand as possible. You can see we've highlighted the areas of your interest. One, the top one there in yellow is total variable selling expense should not exceed, for the dealership, 17%. There's a lot of other little columns that go into that and create that. Okay, I would not be that concerned with those if I were you. Did I make that? I don't think I made that clear, did I? Okay, the one that's important here is the yellow line where it says total variable expense. Then you have other accounts that go into that. We're not as concerned with those other accounts as long as you're in line on the yellow line. Because you may be high for some reason in the other ones, and that's okay. Because you can adjust it in the other. You can adjust that in the other areas. Same thing now if we go down here is total personnel expense should not exceed 36% for the total leadership. And on and on. But that's the thing. Now, don't get, because a lot of times in the 20 groups, we have dealers get all hung up in these individual accounts, and we're not that concerned about the individuals. Just balance it out with the other ones, because every store is different. I wish if we had some master plan and say you can run every store the same way, and this is what you do with every store, we'd do it. But it's not out. It just isn't there. I mean, you can have two stores. We could have a store. I could have a store. They're right beside each other. They're the same franchise, which of course will never happen, and they'd be two entirely different stores. It's just the way it is. But these are the guides. And these guides are not made up by us. What these guides come from is the compilation of the best numbers of the dealers within that franchise. So these are real deals. I mean, we have dealers that are performing within these or better than these guides right here. And it's not our opinions. It's just, like I said, it's a compilation of all the information. Yes, sir. These are guides. We'd like you to be that number or less, and where it's yellow. And you may not be able to do that in your store in all of these, okay? You may be too high in variable expense but lower in personnel for whatever reason, or vice versa. And that's okay too, because what we're trying to do is get you to the bottom line here where you're most profitable right down here in the bottom line.
One thing that I love doing is taking those guides and taking the dealership's sales or the dealership's gross, depending on what they're factored on, and then having one column on a little spreadsheet, the current month's financial statement, and in the next column, taking those percentages and applying them to that store's either sales or gross of what it should be. And you can talk all day long about, if you want to, about percentages. But when you do that, it translates into dollars. And you can see on the bottom line how much you're leaving off. Because if you're at 1% and the benchmark is 4, 3% of whatever your sales is, if you did $1
Is a
million
ton.
in sales that month, is how much you left off the bottom line. And you can talk all day long about 2 or 3%, and it's nice to talk about, but when you translate it back into what it means to your store, it's a great tool. And I rarely see dealers do this, but it is a really, really effective tool to see exactly where you're out of line. Because what you're doing, if you apply Bill's guidelines in a little spreadsheet, multiply it by your gross, you can say my variable expenses should have been X. Instead, they were Y, and the difference is how much I gave away.
We did exactly that. We have came up with a spreadsheet that is what you call a live spreadsheet, a live financial statement, and it's based on every single manufacturer out there. And what you do is you plug those numbers according to your financial statement, and across from it there is the guide. And then from there, you can see what you are up in black or red, and you can just completely
Thank you.
manage it
Sorry,
accordingly.
forgot.
That's all right. So what's nice about it is the spreadsheet that you have, by the way, on that little flash drive. Everybody got their flash drive. It's in that flash drive, and that spreadsheet, if, for example, for you're as a new general manager at a brand new Suzuki store, it's going to give you the guides of what the NADA recommends. Yes, it's live, and then you plug your numbers, and you can see clearly what you're good on or what's bad, and then you can make decisions accordingly. You're the general manager. You say, I choose to pay my salespeople 15%. Great, as long as you are choosing to take away from others, other brackets, because the bottom line is our goal is 25% net to gross, 35% net to gross, maybe 45% net to gross. You know, there's some people right now consistently right at 40, right? It's not like a wishful thinking. It's happening right now, isn't it?
Where you want to be, our guide normally is 28 to 36% return on assets. And if you're in that particular range, you're going to be doing well. It's as simple as that. Let's talk a little bit, Greg, what your opinion is about rat-holing things. What's your thought?
Rat-holing things?
Let me give you a couple examples. I was telling him this morning at breakfast, I almost lost my job in the first store I ran because I made a decision. You know, we're going to get to this later, I hope, is on forecasting. We used to always forecast, and we forecasted where we want to be at the end of the year, and then you broke it down by semi-annually, then you broke it down by quarter, brought it down by month, by week, and by day. And so what I did was, you know, we forecasted X amount of dollars in advertising, and I don't remember what that number was. Let's say it was $50,000 a month. Well, I made a decision, and I didn't tell the dealer this, was that we were going to go ahead and expense that anyway. So let's say it was $50,000, we spent $30,000, well then we expense $50,000 and put $20,000 off in a little rat hole account. And at the end of the year, it ended up that we had saved or had accrued $300,000, because why I wanted to do this was that December was always a kind of like a bummer month in that store for our managers and they would walk around and everybody's happy. It's Christmas and Thanksgiving and all that, and New Year coming and all that, and the parties, and but they weren't going to probably make a lot of money in December. And then you had to pay for December in January, and you didn't make a lot of money in January from the December business. So the first year I did that, I told the business manager that we had accrued just in advertising $300,000. So I said, let's pay the managers, all the managers in the store on that by the 10th of the month, so that now that they'll be happy and have a better kick in their step because they know they've already made a good bonus this month. And I thought everybody would be happy, and everybody was, except the dealer. He was livid with me because I had taken his money and set it aside and hadn't told him. So we had a discussion about that, which I won't repeat, but I mean, it got pretty stout. He got pretty red in the face and all that, got left the room, and he didn't talk to me for a couple of days, and finally came up to me after a couple of days and said, you know, that's a pretty good idea. I'm glad you did it. I'm glad you didn't tell me, because if you would have asked me to do that, I would have told you no. But as it is, it's made everybody better. We had the best December that month that we had ever had because people's attitudes were good. And so I'm not telling you to do something like this, but when I was talking with Greg about this, about rat-holing things, I mean, that was just one of many things when I was in the business that I used to do, because I always felt like the more money I could pay my employees, the happier in the long run most of them would probably be. You know, I kind of always want to have the golden handcuffs on them because where are you going to go to make more money or have a better working environment than you have here? And by and large, it worked because we very, very seldom ever had to fire anybody. You know, we just try to do a good job hiring and that, but anyway, I digress. What's your opinion about that?
I see two extremes of that.
Yeah, I'm sure.
Typically, in what I look at. There's the guys who are behind the curve and the guys who are ahead of the curve. And what you're talking about is getting ahead of the curve.
Yeah.
In other words, you're recognizing expenses before they're actually being incurred.
Right.
You're averaging out the year. And you're setting up a reserve that you can utilize later on for some purpose, whether you just bring it back into profit or whether you use it to smooth out a month or whether you use it when you've got an exceptionally large expense hitting you that particular month for some reason or the other. The other extreme that I see is where guys are behind the curve. And what I mean by that is they're taking expenses out of the P&L, sticking them over in prepaid expenses a lot of times, or some other balance sheet account to make the profits look better than they really are. The money's not in the store. It's never going to be in the store. It's going to be written off at the end of the year one way or another, either by the office manager or by the accountants when they come in to do the tax work at the year end. And everybody's going to be overpaid in the dealership as a result. If I had to choose between the two, I choose Bill's method. You're understating your profit as opposed to overstating your profit, okay? If you do that, what he's talking about in a publicly traded dealership, you go to jail.
No, I'm not talking about doing this public. I don't think there's anybody public in here, are there?
I'm just saying, it's against the law to do it in a publicly traded company. Some of the best dealers I've got, though, do exactly what he's talking about. They'll set aside money every month. If they made $100,000, they're going to take 10 or 20 grand off the statement, off the P&L for that particular month, and they're going to put it in some kind of reserve because they know something's coming down the road. Either it's going to be taxes, it's going to be a downturn, it's going to be a big floor plan expense one month or whatever. The problem, though, is it's a great way for somebody to steal money and you not know it, number one, if nobody's watching it. I see it also happen a lot of times with used cars because what's happening is you've got this little fund over on the right side of the balance sheet. It shows up as a liability on your financial statement. It looks like you owe somebody money. It's not. It's deferred profit. And if that account's not scheduled, and if you or the general manager or the dealer are not watching the ins and the outs of that account, and you build up $300,000 in it, if nobody's paying attention to it, I can charge $300,000 there. It'll never hit the P&L and walk off with the money. I got to get it out of the store, but I can walk off with the money, and nobody will ever know the difference because you've already expensed it on the statement. So if you're going to set these reserves up, be very, very careful on who can look at them, who can put money, charge money against them. Have very, very clear policies. I submit that only the owner should be able to charge anything against that. One of the dealers I've got, he takes out his distributions through that reserve account so he doesn't have to explain it to his banker. We move it at the end of the year, we clean it all up, but he doesn't want to have to explain to his bank every time he pulls money out. Another way I see them used a lot is in used cars. And there's a certain, and I tend to agree that what you're doing with used cars is you're providing now for future loss. I don't care how good you are as a used car manager or used car buyer, you're going to occasionally buy a car you can't sell, right? True. Okay, so you're going to go out to the auction, you're going to buy 10, 15 cars, you're going to bring them back, and out of that, there might be one or two or three that you're going to have to take back to the auction 60 days later to get your money back working in the store. You would not have bought those cars if you didn't think you could sell them, right? I mean, you're not intentionally buying something you don't think you can sell. You might be taking a shot at it, you might be trying something new and different, but you're not intentionally buying a car you can't sell. Cars generally drop in value, right? Generally, except if you buy in December and sell in March. But other than that, they generally go down over the couple of months that you own them. So there is a loss that you're going to take. For every 10 cars you buy, if there's one you're going to take back, there's a certain amount of loss that's going to happen. If you provide for that loss as you go, you're recognizing it on your P&L, you're reducing your gross by just a little bit so that if you've got to go and take several cars to the auction at one time and have a big hit, it doesn't adversely impact your statement. I see that done two ways typically. One is they'll add costs to the used cars when they stock them in. Is that what most of you do? Put the other side in a reserve? The danger with that is it's hard to track. And if you wind up using more of your reserve up, all you've done, if that reserve goes to zero and you've added $100 to every car that's on that you've got, and you've got 100 cars in stock, you just added 100 grand to cost. That's bogus. It's bogus profit. Okay? I'd like to encourage the dealers to do the opposite of that. And that is when you sell the car, take $100 and stick it in a reserve account at that time to provide for those wholesale losses you're going to take later. Does that make sense? It's the opposite. It's getting ahead of the curve instead of being behind the curve. Because it's too tempting if you've got a marginal month, and even some good dealers do it, to go use up that used car reserve to make your statement black for the month, because nobody wants to lose money, right? So they use the reserve up, they do it 2 or 3 times, pretty soon it's gone, you're out. It only makes a difference if you wind up having less in reserve than cars in inventory.
Yes, then that liability account hasn't been balanced.
I've got an example of a used car schedule here. This particular dealer is doing the same thing we're talking about. He's doing what you're talking about, adding it to the cost when he buys the car. And what he's doing is he's got a separate reserve account that prints right beside the used car inventory. This is used car inventory. This is his reserve. So he can see what his reserve is on every single car that he set up. If you do something like this, you can track it. But a lot of times I see them in 2 separate schedules. It's almost impossible to keep up with. You've got to manually go through and add up all of these little $100 packs all the way through the schedule to see how much, if it balances out to what you've got in the reserve account. If you schedule it like this, you can track it. Does that make sense? So it's providing, the reason this guy's doing it is because what was happening is he was going up to Cleveland in the middle of the winter and trudging through the snow to get the best deals, and he was buying Cavaliers for $2,000 under, what did he pay for a Cavalier? $10,000. He was buying it for $8,000, whatever it was. Going through all this hassle, coming back to the store, booking them in at $8,000. They would all go flying out of the store. They were making $1,000, $1,200, $1,500 a copy when they should have been making $3,200 a copy, right? If the book value is $10,000, he's buying them for $8,000. He shouldn't be making $1,200 a copy. So we set this reserve up as a way for him to bring them back, because what was happening in his store, it's not the right way, it's not the way I recommend, but he was having, everybody had access to accounting cost. I don't know why, but they did. And so he would say, everybody knows what I paid for the car, everybody's got access to the accounting cost, so we changed the cost that they could see. They can see this column, they can't see this one. So we're just fooling the salesman is what we're doing.